If you were a buy and hold investor from 1994, congratulations, good job, well, way to go. You're up about 270% in the last 20 years. But the real key to any strategy, though, is to be able to stick to it when the times get tough. So, do you think you are emotionally capable going forward of sitting through the tough times? Are you going to be able to stick it out during the next bubble breaking where you lose 30, 40, 50%, such as the tech bubble or the credit crisis? Bottom line is most people can't do it, and this is the problem. I see this with my clients, I see this with my subscribers. You make a couple losing trades and instantly there's angst, there's, oh my gosh, nothing works, I gotta switch. And this is the big problem that I think most individual investors have. They don't stick to anything long enough for it to work for them. I wrote a paper once, something along the lines of people aren't patient enough to get rich quick. By that I meant that if you allow yourself to stick with a system and you have a decent system, over a 10-year period of time you could do some serious damage. But most people don't have the patience when times get tough to stick it out. And that's really the key. Most people sell at exactly the wrong time. And I'm talking about individual investors. I'm not talking about just individual investors. I know a lot of pros who like to sell at exactly the wrong time. They sell when their stomach hurts. They sell when the market is making them feel particularly stupid, because people equate stupidity with being wrong. But in reality, and I think anybody who's traded knows this, but being wrong is part of the game. It's a little like baseball. You bat 400, you're doing a great job, but you're still going to be out. You're going to be wrong 60% of the time. I'm going to show you an indicator today that's only right, only correct 42% of the time, but yet it kicks the daylights out of the stock market. So that old concept of let your winners run and cut your losses short is at work here, and it's something to keep in mind. Now, most people sell when it's obvious that things are really bad and the media is telling us that the world's going to end and the markets are never going to improve. However, I can tell you for a fact that this is a really bad strategy. The average investor takes defensive action in their portfolio after the cows have left the building. It's when they get scared. And then they return to the markets when things feel good again, when they're safe. Well, when is that? Since 2009, ask yourself, when has it been safe? I'm guessing most people feel probably in the last couple months. We wait for the market to gain 100%, and oh, okay, it's okay to get back in the pool now. Well, this is not a great way to play this game. The problem is this approach, by selling when things are bad and then buying when things are safe again, it causes you to lock in huge losses and then miss big gains. I'm not sure you are aware of this fact, but if you go back and study the history of the bull market since, say, 1900, average bull market gains 81.2% or something along those lines. It lasts 3 years or so. The key is, though, that about 1/2 of the gain occurs in the first 1/3 of the time. So if you are waiting for things to be safe, you're going to miss the biggest part of the bull market. So the key is you've got to have a strategy that can both get you out, but that can also get you back in. So you need to have a strategy on how you're going to deal with market volatility in your portfolio. And remember, it almost doesn't matter what that strategy actually is. Just pick one and follow it. So enough of this philosophical stuff, I know. Let's talk some sell strategies, shall we? Number one, let's talk about a simple trend following approach. And by trend following, we're talking about following the price of the market itself. We're not using indicators. We're not using our gut. We're not using anything except the simple price of the S&P 500 or any index you'd like. Now, a couple things to know. A trend following strategy doesn't require a lot of work. It requires a little work, but it requires a large amount of stick-to-itiveness. So if you're somebody that likes to flip-flop from strategy to strategy, don't start this because you'll blow yourself up. Trend following, though, most definitely will keep you on the right side of the major moves in the markets. I guarantee it. Well, I can't say guarantee now, can I? I'm pretty sure it'll keep you on the major moves in the market. But it will also drive you absolutely batty at times. Because, see, the markets don't always trend. Sometimes they go sideways. And trust me, when the markets go sideways, you're going to feel dumb. You're going to look dumb, and you're going to just feel awful because this approach doesn't work very well in a sideways market. But if you stick to it, the market will go back to a trending mode, and you will catch the big bull waves and miss the big bear declines. And I think that's the goal. Now keep in mind, this is a very, very long-term approach. It's not for somebody who's looking for short-term or day trading or anything like that. This is just silly for them. Because this is a 15-month trend following system. Yes, month. So here's the way it works. At the beginning of every month, what you do is you take a look at the S&P 500 and then you look at the 15-month moving average. And what I like to do is I like to use a weighted moving average as opposed to exponential, simple, or 10 other kinds. I like weighted. And then I move everything forward 2 months because it smooths things out nicely and I like the signals better. So I take my 15-month moving average and I look at the S&P 500. If it's above it, I'm supposed to be in the stock market. It's that simple. If the S&P 500 is below its 15-month moving average, well, you just either go to cash if it's a new move below, or you stay in cash. Again, not hard stuff. So I like the indicator. I wouldn't trade it exclusively, but I actually use weekly and monthly indicators on a daily basis. Look at them every day. So the second sell strategy that I'm going to talk about is using market sentiment. Market sentiment is it's the gut reaction stuff. It's the, well, I'm feeling bullish, I'm feeling bearish, I'm feeling like neutral, I don't know. So what happens is a company called Investors Intelligence does a survey every week, and they publish the results of those surveys every single week. The people are asked to indicate whether they're feeling bullish, bearish, or whether they're expecting a correction. So here's the indicator, and there's some math involved here, so you need to have a spreadsheet. It's probably the easiest thing. What you do is you take the 10-week average of the following formula. You take the number of people that say they're bullish, and you then divide that by the number of people that are bullish plus the number of people that are bearish. Okay? When that 10-week average is above 69, since 1970, stocks have lost 1% a year. Huh. So what that's saying is when people are really optimistic, then stocks lose money. Interesting. But when the 10-week moving average is below 53, which would indicate that optimism is not very high, stocks perform quite well. In fact, since 1970, stocks have gained 12% per year when the indicator is below 53. So when the indicator's below 53, we make 12, and when it's above the other number, well, you lose 1. Pretty good spread. It's the nice data, but that's really not the sell signal I'm talking about. The sell signal is given when the 10-week moving average moves below the number 67. This scenario occurs after a period of extreme optimism has been achieved, and this is the really important part, and then has reversed. And again, I need to stress this. These days, everybody knows every indicator, and everybody wants to be a contrarian, right? Everybody wants to say, well, I'm selling when everyone else is buying, okay? Problem is, just going contrary is a silly idea. If you want to do this well, you need to wait for the sentiment to become extreme, either positive or negative, but understand that if you have an extreme reading, something big is usually going on in the market. And that something big is likely to last. It's likely to stick around. So just because things are optimistic doesn't mean it's time to sell. I can't emphasize that enough. What you have to do is wait for that optimism or that pessimism to reach an extreme and then reverse. That's really the key. For the past 42 years, there have only been 15 sell signals from this indicator. So that's one sell signal every 2.5, 2 3/4 years. Of those 15 sell signals, 13 have been accurate or right, profitable. So that's 87%. The signal occurred before the declines of 1974, 1977, 1984, 87, 98, 2008, and 2011. Okay, sell strategy number 3, something completely different. Let's take a look at the technical health of the sectors or the industries in the market. You probably know that the S&P 500 is broken down into 10 sectors, and you got a picture there: consumer discretionary, tech, telecom, utilities, etc. There's also, you can break it down into 20 industry groups and then 104 sub-industries. So the idea here is to look at the technical health of each individual industry group. And by technical health, let's keep this really simple. Is the industry group above or below its 200-day moving average? If it's above the 200-day moving average, that's probably technically healthy. Things are good. If it's below, it's bad. Really simple stuff. Then what we want to do is stay in line with the message from those groups. So here's a summary of the strategy. You buy when 58%, or the vast majority of the sub-industries are technically healthy. Okay? And I see, yeah, above 200 a day. So you then sell when 45% or less of the sub-industries are technically healthy. So how's this work? Since 1979, using a long cash approach, which means you're either in the market or in cash, when using the buys and sells, you got a 15.3 average compound rate of return for the system versus 8.5 for buy and hold. Not bad. This means the system's returns are 80% better on average than the buy and hope approach. And this also means, or remember, that at 15.3% per year, money doubles every 4.7 years using the rule of 72. And this compares to about 8.5 years it takes to double for an 8.5% return. Now, if you want to be aggressive, you can use a long-short approach. This is a longer-term indicator, so the short can be a little tense. But if you use that long-short approach, now you've got an 18.3% average compound rate of return versus 8.3 for buy and hold. This means that the system is more than 2 times better than the buy and hope approach, and it means that at 15.3% per year, money doubles every 3.9 years as compared to, again, the 8.5. The problems with this strategy, because trust me, if you're going to use a strategy, you'd better know what the problems are. You look at the pluses, but you also have to look at the minuses. First of all, it's very long term, and it can get out of whack, and it is useless, absolutely useless for corrections of 5 to 10%. It doesn't even notice. So it really needs a bear market in order to be successful. So if you're going to use this type of approach, you need to know that, well, I'm going to make my money here over the market cycle. I'm going to catch the majority of the bull market, then I'm hopefully going to miss the majority of the bear market. Very long term, not a fine-tuning instrument at all, but again, it's another way to tell you what type of environment you're in. The next strategy I call trust the thrust. And this is a momentum strategy, pure and simple. When the market surges quickly in one direction, it usually means that you've got a thrust on your hand, and that means that the market or that move is likely to continue. Our fifth and final sell strategy, and I realize I'm running a little behind, is that we're going to build a market model. We're going to build a black box. We're going to build a model that tells us what's going on in the market. It'll put a whole bunch of indicators into the hat and then have it give us a single number that we can work with. I could spend hours reviewing all kinds of strategies to keep you on the right side of the market. But since I've got a limited amount of time, let's cut to the chase. I'm going to tell you about my favorite approach. I'm not really a momentum guy. I'm not really a trend guy. I'm not a mean reversion guy. I'm a market environmentalist. This does not mean that I invest in green companies or focus on the earth environment. Yes, we should all do all that, right? But the plan here, for me, being a market environmentalist, is to stay in tune with the market's environment at all times. So when the bulls are large and in charge, we want to be in the markets. When the bears are in control, we want to take a defensive stance and try and preserve capital as best we can. And when the environment is neutral or iffy, well, you got to play a different game. And you got to play differently, be more conservative, and take less risk. So my goal is to utilize a disciplined, unemotional system to guide risk management decisions every day. Okay, now let's spend 1 second on this. I'm an individual that needs to have something to lean on. Even though I've been doing this a very long time and I have a pretty iron-cast stomach, I still get emotional at times and my judgment gets clouded. So when I get confused, I simply lean on my model. I let my model tell me what to do. So I actually don't ever trade on my stomach or don't ever trade on what I think is going to happen. No. Because I know that the model is going to be right more often than not. And even though I might kill it and make a killer call up or down, call the top, call the bottom, no one in history has ever been able to do that consistently over the years. No one. Repeat. Zero. Nada. No one. So I depend on a disciplined, unemotional system to guide me. I want to focus on the important moves. I want to keep things simple. I just want to make one decision once a day. Where should I be? Should I be long, short, or just standing on the sidelines? So again, I want to stay in tune with the market environment. So how do we do that? Well, by building an environment model, of course. So the market environment model, which drives our decisions, is designed to identify the environment and then keep us on the right side of the market's really important trends. Here's the components. And since I'm short on time, I'm going to keep these pretty brief. We use a trend and breadth confirm indicator as one of our inputs. We look at the price trend, we look at the trend of the breadth, and when those two are both either positive or negative, it's a very good indication. By the way, this is a lousy indicator for buy and sell, but it's a great indicator to confirm what the environment is. We then take a look at, I write about this every month, a cycle composite. History does not repeat. I do not believe in crystal balls. I do not believe in predicting what the market will do. However, I can also tell you that Wall Street and its traders loves a good trend. So I can also tell you that the stock market at times eerily follows the 1-year cycle or the 4-year presidential cycle or the 10-year decennial cycle. So what actually Ned Davis Research does this for me, but what they do is they combine the 1-year, the 4-year, and the 10-year, and they come up with a cycle composite. And when this cycle composite is on, when the market is following it, it's scary good. And then it gets out of whack and takes a while for things to get back in tune. But it's right enough that I want to keep it as an input into my market environment model, just as an indicator of, okay, what might happen next. I also look at demand volume. I don't care about supply, but the key is to think of this as up volume, down volume on an advanced decline cumulative type basis. So we track a demand volume for the stock market. And when demand volume is in tune with the market, you know you've got a solid market. And you can't use the NYSE. You have to only use a stock-only indicator here. You can't use, the New York Stock Exchange has too many ETFs and bond funds and crap like that on it that really skews it. We also look at the short-term price trend. We look at the intermediate-term price trend. We look at a sentiment model. And yes, that Investors Intelligence is one of the inputs in the sentiment model, but the sentiment model includes probably 10 or 15 different indicators. We have a risk-reward environment model that we look at, and we also have an adaptive trading model that's designed to adapt to various environments and does different things in different environments. We also look at the economy, which, believe it or not, is not, as an aside, is not always a predictor of the stock market. It is always not a driver of the market. Sometimes it is. Right now it is. But believe me, the environment will change at some point in the next few years, and the economy is just going to go by the wayside and we'll be focused on something else. And then we also, the technical health of the industries, we use that I talked about. So the end result of these indicators is a market model, which, well, you can think of it as a stoplight. It's really that, you know, I like to keep things simple. When the light is green and the model is positive, history tells us that the odds favor the bulls, and you can be long the stock market. Heck, you can be leveraged long if you want. When the model is negative, we know that the odds favor the bears. Will the next negative market model signal be right? Who knows? But we know that history and the odds are on our side, because the vast majority of the time when the model is negative, the market goes down. Then when the model's neutral, or when you got a yellow light flashing, we switch gears and go into what I call a short-term trend following mode. And the idea there is, yeah, you're going to get whipsawed by following the short-term trend, but you want to be ready for the next big move. And the only way I know to do that effectively every time is to follow all the short moves so that you're right there for the big move when it really starts to